The week is about to draw to a close, and we open a window to what next week has in store for the markets. On a monetary level, we make a start on Tuesday with BOJ's interest rate decision, continue with Bank of Canada on Wednesday, and on Thursday we have a bonanza of interest rate decisions from Norges Bank, Central Bank of Turkey and ECB. As for financial releases, after a relatively quiet Monday, we note on Tuesday the release of Australia's business indicators for December, Eurozone's preliminary January consumer confidence, and New Zealand CPI rates for Q4. On Wednesday, we note the release of the preliminary PMI figures of Australia, Japan, France, Germany, the Eurozone, and the US for January, while we also get Japan's trade data for December. On Thursday, we get Germany's January IFO indicators, Canada's business barometer for January, and from the US, we get December's durable goods orders for December, and weekly initial jobless claims figure, while we highlight the release of the preliminary US GDP rate advance for Q4. Finally, on Friday, we note the release of Japan's Tokyo CPI rates for January, Germany's GfK consumer sentiment for February, and from the US the consumption rate and the core PCE price index growth rates, both being for December. The USD is about to end the week well in the greens against its counterparts. On a macroeconomic level, the US manufacturing sector seems to be suffering given the contraction of economic activity implied by the release of the New York and the Philadelphia indexes for January. Also, the industrial production growth rate for December slowed down, showing anemic growth for the sector. Furthermore, the construction sector also seems to have suffered a contraction last month, given the drop of the number of housing starts and building permits. On the other hand, the retail sales growth rate for December accelerated beyond market expectations, implying a resilience of the demand side of the US economy, while it may be also able to feed inflationary pressures. In turn, given the resilience of inflationary pressures in the US economy, the Fed may more decisively maintain rates at the current levels for a longer period of time than what the market expects. Please bear in mind that currently the market expects the bank to deliver 6 rate cuts in the current year, starting from the March meeting onwards. Yet, Fed policymakers tend to repeat the message that the bank may opt to delay any rate cuts. Overall, the continuous persistence of the Fed policymakers that rate cuts should be delayed beyond the market's expectations seems to provide some support for the greenback. On a more fundamental level, we may see the wider uncertainty on a global level providing some support for the USD, yet that seems to remain at weak levels for now, and we highlight as the next big test for the US dollar the release of the preliminary GDP rate for Q4. The pound is about to end the week lower against the US dollar, yet high against the JPY and the euro. On a macroeconomic level, we note the acceleration of the house prices growth rate for January as good news for the UK real estate sector. Furthermore, we also note the release of UK's employment data, which tended to provide some support for the pound on Tuesday for November. The unemployment rate remained stable at 4.2%, yet the employment change figure jumped beyond market expectations, reaching 73K. Also, we note that the claimant count for December dropped, while as a word of caution, please bear in mind that Her Majesty's Revenue and Customs payroll change fell deeper into the negatives. Overall, though, the UK employment data tended to imply a relative resilience of the UK employment market, which may feed inflationary pressures in the UK economy. On the inflationary front, we note that the headline CPI rate for December unexpectedly accelerated to 4% year-on-year if compared to 3.8% year-on-year in November, despite the downward tendencies of the PPI rates for the same month. On a monetary level, the acceleration of the CPI rates is expected to add pressure on BOE to maintain rates at high levels for a longer period, a scenario that may also be allowed by the tighter than expected UK employment market. Yet, the market sees that the bank may be forced to expedite any rate cuts given the bleak economic outlook of the UK. It should be noted that the market, given the acceleration of the CPI rates for December, prices in 4 rate cuts to be delivered by BOE in 2024, starting from June onwards. As for next week, given the low number of high-impact financial releases expected from the UK, we may see fundamentals leading the way for the sterling. JPY is about to end the week in the reds against the US dollar, the euro and GBP, in a sign of broader weakness. On a fundamental level, we note the relative uncertainty in geopolitics, which may provide some inflows for the yen should market worries intensify in the coming week, given its status as a safe haven. On a macroeconomic level, we note that the machinery orders growth rate for November marked a wide contraction, implying a lack of confidence on behalf of Japanese businesses to actually invest long-term in the Japanese economy. On the inflationary front, corporate goods prices for December slowed down on a year-on-year level, maybe not as much as was expected, while the CPI rates for the same month also slowed down, both on a headline as well as on a core level. The slowdown of the CPI rates tends to justify BOJ's hesitancy to normalize its ultra-loose monetary policy settings currently in place. Hence, as the main event for JPY traders in the coming week, we highlight the release of BOJ's interest rate decision on Tuesday. The bank is widely expected to remain on hold at minus 0.10%, and currently JPY ORS implies probability of 92.6% for such a scenario to materialize. We tend to expect the bank to maintain its dovish tone, given the slowdown of the CPI rates, which in turn may weaken JPY further. To expect a tweak in the bank's dovish tone, we would require a relative stabilization of the CPI rates in order to show that it is sustainable, something that does not seem to be the case, at least not yet. On the other hand, the market expects the bank to deliver its first rate cut in decades in the June meeting, and should the bank want to start preparing the markets for such a scenario, we may see BOJ allowing for some hawkish innuendos to escape. The euro is about to end the week lower against the US dollar and the pound, yet gains ground against the JPY. On a fundamental level, we tend to maintain our worries about the political outlook of Germany given the prudence of farmers, but also the rise of the AfD. The recent scandal of a conspiracy for the deportation of 2 million immigrants may have been ringing the alarm for Germany politically, yet the far-right movement seems to remain strong and the elections are nearing. On a macroeconomic level, we make a start by noting that Eurozone's industrial production suffered an even deeper contraction for November, being another signal of the sufferings of the sector. Furthermore, the outlook for Germany tended to be more optimistic in January, yet conditions on the ground for the largest economy in the Eurozone seem to have deteriorated slightly. We also note that the acceleration of Eurozone's HICP rate for December was confirmed, a scenario that may force the ECB to keep a harsher rhetoric in its coming meeting on Thursday. The bank is widely expected to remain on hold, keeping the refinancing rate at 4.5% and the deposit rate at 4%. It's characteristic that Euro ORS imply a probability of 96% for such a scenario to materialize, which more or less tends to set the interest rate part of the decision as an open and shut case. Market focus is then expected to shift towards the release of the accompanying statement and a bit later towards ECB President Lagarde's press conference. Please note that the market expects the bank to deliver 6 rate cuts in the current year, starting from April onwards. Yet, given President Lagarde's recent statements, it seems that the bank is orienting itself towards starting to cut rates by the summer, but at the same time seems ready to take its time to proceed with the first rate cut, as it wants to be more certain that inflation has returned to target. On the other hand, the Eurozone is facing a recession, which in turn increases the pressure on the bank to start cutting rates rather sooner than later. It will require very fine balance in the accompanying statement and President Lagarde's press conference in order not to affect the common currency, and it may be difficult for such a fine balance to be achieved on Thursday. Should the bank seem to be in a more of a hurry to start cutting rates, we may see the euro weakening and vice versa. AUD is about to end this week lower against the US dollar for a third consecutive time, and we know that this week's drop seems to be the widest of the three. On a macroeconomic level, we note that Australia's employment data for December disappointed Aussie traders, as despite the unemployment rate remaining unchanged at 3.9%, employment change fell deeper into the negatives, reaching minus 65.1k, implying another crack of the tightness of the Australian employment market. The release could milden any hawkish tendencies of the RBA, and for the time being, AUD/OS implied that the market seems to be pricing in only one rate cut of 25 basis points in 2024, and that is to be delivered in the fall. On a deeper fundamental level, we note the release of the Chinese data in the past few days, which was encouraging for Aussie traders. It was characteristic that China's GDP rate for Q4 accelerated, maybe a bit less than expected, yet nevertheless indicated that the Chinese economy grew at a faster pace than in quarter 3. At the same time, we had better than expected growth rates for China's industrial output and urban investment for December, which could support further growth in the coming quarter. On the other hand, the demand side of the Chinese economy seems to be easing, forcing Chinese factories to increase their dependency on exports. On an even deeper fundamental level, we note that in Taiwan, DPP-1 Overall, though, China seems not to intend an escalation in their relationship currently, which may have been another positive. The loonie is losing ground against the US dollar for a third week in a row. On a macroeconomic level, the housing starts figure for December came in higher than expected at 249.3K versus the expected figure of 243K, which could temporarily aid inflationary pressures. Yet, such an effect does not appear to have aided the loonie, as it is a secondary indicator compared to the CPI rates. We note that December CPI rates were released on Tuesday. The release tended to send out mixed signals as the headline rate accelerated, yet at the core level, inflationary pressures tended to ease. We note that the CPI rates are within the bank's target range of 2 plus minus 1% at the core level, yet we also expect the bank to require more and more consistent evidence that inflationary pressures have eased further. On a monetary level, we note BOC's interest rate decision, which is set to be released next Wednesday, with CAD-OIS implying an 84% probability for the bank to remain on hold. A view we tend to agree with, yet we would go as far as to hypothesize that the bank in its accompanying statement may adopt a more hawkish tone and could warn the market participants that a single financial reading may not be convincing, which in return could support the loonie. The market, though, is currently expecting the bank to deliver 4 rate cuts in the current year. Should the bank intend to start preparing the markets for possible easing of its monetary policy, we may see it adopting a less hawkish tone, which in turn may verify the market's suspicions and thus weaken the CAD. On a fundamental level, we note that oil prices remained near the same levels as the week began, yet a possible rise in oil prices, possibly due to the tensions in the Middle East and the Red Sea, may provide some support for the CAD in the coming week. In the coming week, we expect the US dollar to maintain the initiative over other currencies in the FX market, mostly due to the release of the preliminary US GDP rate for quarter 4. Yet, given the interest rate decisions scheduled next week, we may see the Euro, JPY and the CAD escaping USD's sphere of influence at some points. Furthermore, the preliminary PMI figures may also provide a chance for some currencies to set their course. US stock markets seem to be sending mixed signals and are some signs of hesitation as the Fed's message for lower number of cuts starting at a lower stage slowly sinks in. Releases of earnings reports are still expected to keep the interest of equity traders alive in the coming week. Furthermore, we know that the Fed's message seems to be slowly sinking in and has pushed US yields higher in the past few days, understandably weighing on US equities markets and gold's price, given also that the precious metal is non-interest bearing in contrast to US bonds. It should be noted that the negative correlation of the US dollar to gold's price was maintained in the current week, and should the US dollar strengthen further, we may see gold's price searching for low grounds. We hope that you found this report useful, and from all of us here at IronFX, best wishes for solid trading.
Okay, thanks for waiting, everyone. Let's go ahead and get started. Okay, first things first, as per usual, a risk warning. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. Disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so I'm Melanie. I will be your speaker for today. I'm an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. Firstly, we're going to look at the anatomy of a trade, and then why exactly you shouldn't use a fixed take profit or fixed stop loss. And then we'll talk about what is the proper stop loss and take profit placement, followed by dynamic stop loss and take profit placement. Okay, so the anatomy of a trade. So a trade basically consists of three basic components, right? We have the entry, which is where you place your orders, and then you have, of course, your stop loss as well as take profit orders. Okay, so in order to manage a trade, it's important to understand what it consists of. So in this webinar, we will be introducing the basics of trading, which are the three on that we just went through. And we'll go through break even, partial profit, idea and validation in part 3, and part 2, and trailing stop loss in part 4. Okay, but it's important to know all of these as well. Okay, so trade management basically refers to the process of managing open trades in the financial markets to maximize returns and minimize risk. Okay, so here are some um, reasons why it's important to have a proper trade management strategy. Okay, firstly is to control risk. Trade management strategies such as stop loss orders and position sizing help traders to limit their potential losses and manage their overall risk exposure. Next, we have to maximize profits. So trade management strategies such as take profit orders and trading stops basically help traders to lock in their profits as well as maximize returns. Thirdly, manage emotions. So the discipline and structure that trade management or having a proper trade management strategy provides can help traders to stay calm and rational even in very volatile markets, which can prevent impulsive decisions driven by fear or greed. Okay. 4. Improve trade efficiency. So by having a well-defined trade management plan, traders can make faster, more informed trading decisions, okay, and avoid the cost and time of having to constantly monitor and adjust their positions. So for many traders who have full-time jobs, if they have a proper trade management strategy, you can actually just lock in your trades and then ensure your stop loss, take profit levels, maximize your profits, and then just go about your day and then come back at the end of the day to check your results. Okay. Next, lastly, we have to increase consistency. So effective trade management helps traders to achieve consistent results over time by reducing the impact of individual losses and maximizing the impact of winning trades. Okay. So let's start off by going through the issue of having a fixed take profit or stop loss. Okay, so firstly, let's take a look at this example. So the red area over here, you can see this red resistance level here. So this shows us a strong resistance area since we have two swing highs or we can see that price has reacted off this area twice. Okay, and it aligns with this red area that we've highlighted. So if our trading strategy requires us to have a fixed take profit of 100 pips, okay, look at our point 2, take profit of 100 pips. This would place the target beyond this strong resistance area. Okay, so our entry is over here, and we're expecting price to go from our entry to this resistance level here. Okay, and this is how it plays out. Price shot up, right? So our target profit was at this resistance level, and price did shoot up as we expected, but it missed our take profit target by a couple of pips, and then it reversed back down to our entry. And the reason for this is because price often reverses off of big areas of resistance and support. So if you have a confluence area like this, often supported by, I mean, it would be better to support it with Fibonacci levels, pivot points, whichever levels you prefer. Yeah, but if you have a confluence area, it tends to attract price, but you would also see price reversing off of these big areas of resistance or support. Okay. Now, in an alternative scenario, if we had placed our take profit before the key resistance area, we would have gotten a profitable trade. So if we had placed it slightly below, okay, we would have caught price before it reversed. Okay, so the important thing to note from this is to look at the charts and adjust your take profit and stop loss levels accordingly, and not just blindly follow a fixed take profit target, such as 100 pips like we did over here. You know, it's always important to look at the charts and then adjust accordingly. Okay. So this is our general guideline to follow for proper stop loss or take profit placement. So if we're looking at having our stop loss at a major resistance area, we will place our stop loss beyond it. So in this case, it will be above it. Whereas if you're looking at placing your take profit at a swing low, okay, we would place it before a major support area. And of course, it would be the opposite if it's switched around. Okay. Yeah, but this is typically the proper stop loss and take profit placement that we recommend to ensure you maximize your wins and minimize your losses. So your stop loss should be always placed beyond any confluence area, while take profit should be placed before. But we'll go through a couple more examples over here. Okay, so trade management with Fibonacci confluence. We mentioned earlier that your stop loss should be placed beyond a key Fibonacci confluence area, but of course, when we say Fibonacci confluence, it can be Fibonacci, it can be pivot points, as I mentioned earlier, it can be just a bunch of different levels that line up in the same area. That's basically what a confluence area is. And the reason for that is because price is attracted to these strong areas of confluence, be it Fibonacci or whichever indicators you prefer to use. And if your stop loss is right before instead of beyond your confluence area, the chances are that you will most likely get stopped out before the market reverses. Okay, and that's basically one of the reasons why most people might wonder why exactly they got stopped out right when the market starts to reverse. And then they often complain about stop hunting. Okay, next, let's look at take profit. So in this situation, you can see that our stop loss is placed below. Okay, it's our Fibonacci confluence in this case is a support level. So if we look at our previous, our stop loss is at the swing highs, whereas our take profit is at the swing lows. Whereas if we look at this example here, it's flipped just to show you guys what exactly you can expect. Okay, so in this case, we're going for a buy entry, and here we are looking at a sell entry. Okay, but the the idea here is still the same. Stop loss beyond, take profit before. So over here you see our buy entry take profit is before the Fibonacci confluence area here, and our stop loss is beyond it, so it's below it in this case. Okay, the reason for this once again is that when price reaches the confluence, the Fibonacci confluence area, there's a high chance that it won't be able to go beyond it because of the resistance at that level. So instead of reaching your profit target, we can often see that it will reverse back to your entry or worse, your stop loss. Okay, and this is another reason why people complain that the market is being manipulated because they might miss their take profit by 1 pip. Okay. Feel free to let me know if you guys have any questions throughout the webinar. Okay, all good. Let's move on. So in this example, we are looking at why you shouldn't have a fixed stop loss. So here we have a support level with two swing lows in line with one another. So you can see here, one swing low here and one swing low here. So this gives us a really nice support level. And we can see that price has bounced off of this support level, okay? And we are expecting price to continue to rise to the swing high resistance over here. Okay, so our stop loss of 100 pips is fixed at the 1894.75 level at the support level over here. Okay, this yellow highlighted area here. Okay, and price goes down instead, touches the stop loss, and perfectly bounces off from the support. Okay, so your stop loss is here. Remember, as our previous slide, stop loss is here, and we're going in for buy, thinking that price will go all the way up to our resistance over here at 1931.43. Okay, but instead it reverses and it bounces off our stop loss. Okay, so the reason for this once again is that price tends to get attracted to key levels of support, especially since in this case we see price reacting off of it twice already in the recent past. So we can likely expect it to bounce off of this level again before shooting back up, which is one of the reasons why what we should have done instead was to place our stop loss, so this yellow area, slightly beyond the key level so that we are not stopped out at the support, as prices tend to be attracted to key levels of support and bounce off of them. Okay, so this is why it's important to have dynamic stop loss and take profit placements. So dynamic stop loss basically is a trading strategy used to manage risk, in which the stop loss level is adjusted dynamically based on market conditions. Okay, so the level of the stop loss is continually moved to a more favorable position as the price of an asset moves in the desired direction. The goal of a dynamic stop loss is to lock in profits while minimizing potential losses. And the placement of the stop loss can be determined by various technical analysis indicators or other market conditions, such as volatility or market trend. Okay, here's a simple example to demonstrate dynamic stop loss. Price has bounced off nicely off of this support level of the 86.721, as we see here. Okay, and we're expecting it to reverse off of our entry here, 87.819, in line with this 100% Fibonacci projection level. Okay, so we see price testing this entry level that's in line with the 100% Fibonacci projection. Okay, and we also see that we have a stop loss level at this swing high here, but we're placing it slightly beyond it, in line with the minus 27.2% Fibonacci expansion, as well as another 61.8% Fibonacci projection. Okay. Yeah, if you're wondering what these Fibonacci techniques are, feel free to let me know in the chat. We basically go through the different Fibonacci techniques in our Fibonacci series. But if you've missed that, I don't mind going through it um, a little bit after our slides when we're going through some charts. Okay. Yeah, so price is currently testing our entry level and we're expecting it to drop back down to our take profit at the 86.721. Okay, so as we mentioned earlier, our stop loss was placed below, but of course, instead, it should be placed beyond the major Fibonacci confluence area. Okay, and we will show you why in our next slide here. So you can see if we had placed our stop loss exactly at this Fibonacci confluence area, we would have been stopped out. You can see it touched the Fibonacci confluence area perfectly and before reversing off of it back down to our entry. Okay, so if we had placed it here, we would have gotten stopped out. And once again, the reason is because price is often attracted to such strong areas of support or resistance before reversing off of these areas. Okay, so price reversed perfectly off our confluence area and hit it back down towards our take profit. Okay, so now let's look at another example. Okay, so here we're expecting price to bounce off of our entry here at the 87.625 level. And this is a pullback retracement, pullback resistance that's in line with a 78.6% Fibonacci retracement. Okay, what a pullback resistance basically means, I think we'll go through this in a little bit, maybe not. Yeah, maybe not. But a pullback resistance basically is when price has retraced this level. So we have a swing low here, right? And price has broken out of this level, surpassed it, and is now heading back to that area. That's basically what a pullback resistance or support level is. Okay, so we're expecting price to reverse off of this level, this entry level here, and our take profit is at the um, swing low support at the 84.668 level. Okay, meanwhile, our stop loss is at the swing high resistance over here at 88.533. So price has hit our entry and has reversed nicely off of it, as you see here, and is now heading towards our take profit. So you can often expect price to test significant levels of confluence like we see over here in our entry and like we've seen in our previous examples as well. You can often see price testing the level before reversing off of it. Okay, so that's the reason why we say that it's important to have a good trade management strategy so that when you encounter these kind of issues, not really issues, but like situations, then you won't get so emotional and want to change your stop loss or take profit levels or change your trade because then you can believe or you can trust in your trade that it will eventually work out in your favor. And if it doesn't, you have dynamic stop loss techniques to help you to minimize your losses. Okay, so dynamic take profit placement here. Our take profit is in line with a 78.6% Fibonacci projection. This is wrong. It should be projection instead because we have 3 points and we are using kind of like a flash shape over here, or like a lightning bolt shape. Okay, and our 78.6 is in line with our take profit. Okay, so then we can see that price worked out just exactly as how we expected it to and touched our take profit before reversing off of it. Okay, so we just managed to catch this trade over here before it reversed off of it. And you can see it's a good thing that we placed our take profit slightly above this 78.6 level and also above the swing low so that we were able to catch this before it reversed off the take profit and headed up to our stop loss. Okay. So another example here, in this example, we are seeing price break out of this descending trend line. So just to recap, a descending trend line, in order for a trend line to be valid, it needs to have three levels, or rather three touches on that trend line. So here we see one, two, three, actually we have four in this case, right? But we see price breaking out of it, which is giving us a bullish signal. Okay. And so our entry level is placed at this overlap. And basically what an overlap level is when the bulls as well as bears are respecting that area. In other words, you see the swing lows and swing highs respecting that area. Okay, making it a pretty significant area. So here we have our entry level as an overlap resistance, okay, and our stop loss, it is just at this swing low here. And you can see our take profit is in line with a minus 27.2% Fibonacci expansion, 127.2% Fibonacci extension. I think it's also in line with a 78.6% Fibonacci projection. Okay, so you can see price, we are expecting price to rise above this entry level and hit towards our take profit and amongst this Fibonacci confluence area. Okay, but we see that our take profit, when it's placed above the confluence area, it actually missed price by a few pips because price reversed off of this confluence area and reversed back down to our entry. So same idea over here, our take profit should be placed below the confluence area. In this example, we're kind of placing it a lot lower than the confluence area, but in reality, you don't actually need to place it so much lower. You could actually just place it right below the confluence area and would have been fine as well. Just as long as your take profit is placed below it or before a major confluence area, price is more likely to hit your take profit before reversing back down to your entry or even worse, your stop loss. Okay. Okay, that's it for my slides. Now let's take a look at some charts and see if we can implement what we have done so far. So let me know in the chat if you guys have any requests for any charts. Okay, let me just connect them. Okay, I think we have a request for AUD. Yeah, okay, we'll definitely go through that. Okay. Okay. So I typically like to start off by looking at the higher time frames. Wait, can you guys see my charts? Yes, okay. So I like to start off by looking at the higher time frames so that we get an idea of the general direction of where prices are headed towards. Okay, so I'm gonna start off by looking at the weekly time frame. And on our weekly time frame, we see um we see prices moving in this downtrend. Let's see if we have a channel. Okay, we don't have a channel, but we have a very obvious descending trend line here. Remember I just mentioned that in order for it to be a valid trend line, we need at least 3 touches. So we see 4 touches over here. Okay, so downtrend on our weekly time frame. Let's take a look at our daily time frame. Okay, daily time frame is also pretty yeah, price is moving in this descending trend channel as well. Let's just go in with like really quickly with some support and resistance levels. Okay. Okay, here's my first resistance. Um, yeah, first resistance. And then my first support is just gonna be here. And then my second support just here. Okay. So these are just solely based on graphical levels. So I'm just looking for swing lows as well as some overlap levels. So if you guys weren't here for our support and resistance webinar, this is basically what we call an overlap um, support level. Okay, because you can see that we have swing highs as well as swing lows that are respecting this area. Okay. So that's why it's a significant level because price has tested it many times before. Okay. Um, okay, so we see price kind of reversing off of our first resistance here. I think I wanted to point out as well that let's take a look at RSI. Okay. Okay, over here we have a bit of a divergence. Okay, we have prices moving upwards on our daily time frame, whereas over here you see price dropping, or rather price making a lower low. Okay. So this is what we call a bearish divergence, okay, because we see price moving upwards, or rather price making a higher high on our price chart, whereas on our RSI price, or rather on our RSI, we see that it's making a lower high. Okay, so this is basically what it means. You can see it's making a lower high, whereas here it's making a higher high. So this is basically a sign, I guess, that price is likely to drop from here. And we can kind of see it already dropping. Yeah. Okay. That's all for daily time frame. Now let's take a look at our 4-hour time frame. Okay. So on our 4-hour time frame, it's actually pretty bullish. Okay, we can see, I think, okay, we have a ascending trend line. Let's see if we have a trend channel as well. Okay, no. Okay, but we have an ascending trend line. Now let's go in with our support and resistance levels. Okay, here is my first resistance. And the key to this is that you want to make sure that you try and pull back your levels as far as you can so that you can see how significant these levels are. So like in this case, you can see that this is an overlap level because I have mini swing highs, and mini swing lows respecting it. Okay. Yeah, but you don't want to cut through too many bodies of candlesticks. Okay, so if you just cut the wicks like we see over here, just the wicks are fine. Yeah, but preferably not the bodies of candlesticks. Okay. And this will be my second support. Okay. Okay, if I zoom in really closely, I can see that my 50% level lines up nicely with my first support. Okay, so I'm gonna keep that. Mm, yeah, I'm looking for a projection here. And I can see my 78.6 lines up nicely with my first support. Okay, now I'm looking for an expansion. I think I think we will have an expansion here, or maybe not. Mm, okay, so for expansions, we are looking at the negatives. And no, we don't. Okay, let's see what else we have. So you can see here I'm following the shape of the chart really closely. So that's quite important to note as well. Okay, my 61.8 also lines up with my first resistance. Okay, it doesn't have to line up exactly because we're typically looking for areas and not so much specific levels. Okay, so as long as they are like kind of near the area, that's fine. Okay, so we can see my first support is a really significant area. Okay, because I have this overlap support level as well as a 50% and 61.8% um Fibonacci area, confluence area. Okay, so based off of our two let me just see if we have a trend channel here. I might have missed it. Yeah. Okay, so we have an ascending trend channel here. The trend line that I drew earlier was incorrect, and I didn't realize it until now. Okay. Okay, but even though on our 4-hour chart it's pretty bullish in the sense that we see price moving in this ascending trend channel. You guys remember our daily time frame gave us bearish. Our weekly time frame was also pretty bearish. Okay, so just keep that in mind. I'm expecting price to continue to drop towards our first support. Still within this ascending trend channel, of course, but simply because of this confluence area here. Okay, but I think it will react off of it. Let's take a look at some indicators, okay, to support our analysis. So we're expecting prices to drop towards our first support. Okay. MACD is giving us bearish, Ichimoku is giving us bullish, so I'm gonna remove that. Let's take a look at RSI. Okay, once again, RSI is giving us a yeah, bearish divergence. Okay, you see price making a higher low, higher high over here. Okay, price is making a higher high, whereas on our RSI, it is making a lower high. Okay, let me know if that's confusing. I'm not sure if I explained that clearly. Okay, but basically what we are looking at is this highs. Okay, so you see this high as well as basically like the peak of the chart. Okay, we see that over here at the um same area that we're looking at, right? That I've highlighted with the vertical lines. The peaks are higher on the chart, whereas on our price chart, whereas on our RSI chart, it's our peaks are lower. That's just basically what it means. Okay. Yeah, so that's our bearish divergence here, giving us a bearish signal. Maybe we'll take a look at Bollinger Bands. Okay, that's not really telling us anything. Let's look at stochastic perhaps. Okay, stochastic is also giving us a bearish divergence over here as well. So for divergences, you can take a look at either RSI or stochastic. They often give you, if you're looking for divergences, they're the best indicator to use. Okay, so you see here that's slightly lower. Okay, okay. So once again, just to like wrap up, we're expecting it to drop here towards our first support. But after our first support, we'll probably see it reverse back up to our first resistance because of this confluence area. So it'll attract it and then it'll reverse off towards our first resistance. Okay. Okay, I think we have another request for gold. Okay, let's take a look at gold. Okay. Same thing, I'm gonna start off by looking at our higher time frames first. And on our higher time frames, we kind of see an uptrend, okay? On our daily time frame, we also see an uptrend. Let's see if we have a channel here. Hmm, probably not, okay? But you can see it's a definite uptrend here. Okay, and on our 4-hour time frame, it's also pretty bullish. Okay, so we typically will recommend to trade according to the trends. So just follow the trends unless you're using an indicator and it tells you that there is going to be a reverse in trend, and those yeah, then of course you can go in with you can go the opposite, follow the opposite of the trend in that situation. Okay. So firstly here, this is going to be my first resistance. Okay. This is my first resistance. And then Okay, I think I will place my first support over here. Okay, so this is an overlap level as well. We have a swing low here and a swing high here that line up. Okay, and then let's see. Okay, I think our first resistance can go all the way back here, and I'm gonna see if this level can be supported by any Fibonacci levels. Okay, so I'm looking for our projection here. Okay, let's see if we have any other levels. Oop. Okay. Okay, I can see this 161.8 lines up with my first support. And here we're using a Fibonacci extension, okay, which is in the hundreds. Okay, and my 61.8 also lines up. And so does my 78.6. So I'm just gonna keep those two. Okay, I think I'll get rid of this. Mm, okay, I think that's all the levels that we have. Okay, I want to. Okay, my 161.8 kind of lines up with my second resistance as well. Okay, so I'm just gonna highlight it because it's also in line with a 78.6. Okay, I think that's about it. Okay, so we're gonna go in with a buy from our first resistance towards our second resistance. But of course, because our first resistance is in line with a bunch of other Fibonacci levels, so we will probably see price testing this level a little bit. Okay, especially since it's also an overlap level. So we'll see it test it a bit before shooting up towards our second resistance. Okay. Price is moving above the Ichimoku cloud, so it's giving us a bullish signal. MACD is also giving us a bullish signal. Let's look at RSI and stochastic. Um, these aren't really telling us much. Let's take a look at our moving averages. Okay, price is moving above both of our moving averages. So that's a good sign. It's bullish. And we can see on our Bollinger, price is moving above the upper band. So it's also giving us a bullish signal. There's a lot of upward pressure here as we see from our other time frames as well as our indicators here. So we can expect it to continue to push towards our second resistance. Okay. Okay. Do you guys have any questions or anything else you'd like me to go through? Yeah, I can go through one more. Yeah, we can do DXY really quickly. So this will be our last chart for today. Okay, so you can see on our weekly time frame, prices are pretty, I mean, it's kind of ranging, but it looks like prices are dropping here. And our daily time frame also makes it look like it's kind of dropping. But let's take a look here. Okay, so here I'm gonna place my first support, and then my first resistance would be over here. Okay, in line with the swing low and swing high. So it's a overlap level. And then my second support would be maybe just over here. Okay. Now let's go in with some Fibonacci levels again. Um, hmm. Okay, I see price testing our 50% level here. So I'm just gonna keep our 50%. Okay, and then mm, here we kind of see this 78.6 lining up nicely with our first support. I think this 61.8 is a bit too far. Okay. Okay, and then hmm, okay, I think that's all the levels we have. But we see this confluence area here. Okay, so we can expect some resistance off here, which you see is already happening here. Okay, so we're expecting prices to shoot up from this level here. Let's look at some indicators. Okay, 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 it's pretty bearish on both MACD and Ichimoku. Let's look at, okay, pretty bearish as well. Hmm. Okay, maybe. Okay, let's take a look at this on our 4-hour time frame. Okay. Yeah. So on our 4-hour time frame, we definitely see prices kind of reacting off of our first support as well. So yeah, we can definitely still expect prices to continue to increase towards our first resistance. Okay. I think after our first resistance though, we'll probably see prices continue to drop after that. Um, yeah, and because this first resistance is a pretty significant swing high resistance, and we can see prices tested it before. Okay, so it's likely going to attract price here. Okay, at this level, and and it will see price react off of it and continue in the downtrend. But for now, we can expect price to bounce off of our first resistance like it already is and hit towards our first support, I mean. First support, bounce off our first support and hit towards our first resistance. Okay, That's all the time that we have for today. I hope you guys found this helpful, and I will see you guys next week. Have a great rest of your week, everyone. Bye.